Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right. Super excited for my guest today. We've got Jeremy Harbour. He's a SME and M&A expert, investor, and founder of Unity Group and the Harbour Club. Jeremy Harbour is a globally recognized SME and M&A expert who has completed 100 plus acquisitions and helped nearly 100 companies go public across 12 countries. I had his colleague Callum come on a couple of weeks ago, so excited to kind of hear some more perspectives on just taking companies public. After leaving school early and starting out running marketing stalls, he built his career around acquisition-led growth and now teaches entrepreneurs how to build wealth through ownership, private deals, and strategic acquisitions. Some hot topics we're going to talk about is growth through acquisitions versus organic growth. We see a lot of corporates doing this. We've also had within our fund accelerator, we've had ETA funds, so entrepreneurship through acquisition. That's quite popular, especially in the Ivy Leagues. There's a lot of college kids that just, they go to Harvard and they're like, look, I think I want to go out and buy a plumbing business and go scale it. We're also going to talk about how small business owners can engineer their own exit. So thinking through the terms that are friendly for both the entrepreneur and the investor, and just making it a win-win, and why the middle market holds hidden opportunities for entrepreneurs. So those are some of the hot topics, and we'll probably come up with many more. But Jeremy, thanks for coming on and giving us some time.
Yeah, no, lovely to be here. And there's tons we can get into on those headlines you just said.
Yeah, absolutely. Well, why don't we take a step back, Jeremy? I know you're calling from Dubai. Tell me a little bit more about your educational and professional background, and how you walk us through how you got to your first deal. Maybe you worked in corporate for some time, and then what was that aha moment that got you to kind of buy a company?
Yeah, not at all. Started in business when I was very young. I was an entrepreneur from a young age. I quit school at 15. I didn't finish school at all. I was running a business. I was too busy for school. And that went spectacularly wrong. And well, not spectacularly, but it went wrong like most startups do. And so around 18, I found myself having finished that business and looking for the next thing to start. And I got into the telecoms industry. And this was in the 1990s. Telecoms was deregulating, mobile phones were miniaturizing. So the whole market exploded, and the greenfield opportunities, any idiot, including myself, could make money. But what that led to was an incredibly fragmented market where, typically if you look at any industry, there's kind of a pyramid of businesses. You have the whales at the top, the huge ones at the top, and the tiny ones at the bottom. This was a very distorted pyramid with like two big players and millions of tiny ones. And so whenever you get that kind of distortion, there's always a big consolidation opportunity. That consolidation was accelerated by the fact that the market kind of reached saturation. So everybody that could have a phone had a phone now. And the only business was getting people to switch over to your service from their service. And so that was it became more like the insurance business where you're waiting for contracts to expire before you can go and pitch people to move over. And so the market just started eating itself. Everyone was buying everyone else. The easiest way to get more customers was go buy a company that had customers rather than wait for people's contracts to expire. In my mind, I'd never thought about buying businesses. I hadn't had any, I'd not done an MBA. I'd not worked in corporate. I'd not worked in investment banking or corporate finance. And I think that was my biggest asset. The fact that I didn't have all of that weight of information holding me back, basically. So. What I realized is, the reason I didn't buy a business, I didn't have any money and I didn't know what I was doing. And then I realized most of the people trying to buy my business didn't have any money and didn't know what they were doing. And so I figured that, I wasn't in that much of a disadvantage from other people. And so just went out and started pitching companies and trying to get a deal done. And eventually I found a 13-year-old telecoms company that had been trying to sell, couldn't find a buyer, had a few ticking time bombs. It had their building that they were operating from was going to be demolished and turned into apartments, so they had to get out. That was quite a good catalyst for something to happen. And I was able to put a deal together that didn't require me to put any capital in, and we grew by a year's worth of sales in an afternoon, and that completely changed the game. Interestingly, you talked about you talked about ETA. I've not actually heard that expression. I've heard of search funds is normally how I've heard it.
It's the same, interchangeable, pretty much.
I mean, we see a lot of these search funds, and that business, for example, had multiple search funds approach them to try and buy them, and all the search funds, because they'd done the MBA, because they'd studied how Anheuser-Busch bought some multi-billion-dollar brewer. And they're now trying to apply this to a 500 grand phone company, in a provincial town. Obviously, whenever they start to look under the bonnet, everything's wrong, or under the hood, as you would say. Like, everything is wrong. Nothing works. Like, why do they do this way? Why isn't this systemized? Why isn't this on why isn't this documented? Why isn't this in the way? Oh my God, this is a shambles, And these search funds just get analysis paralysis. Can't figure out how they're supposed to give this person this money if all this shit is wrong with the business, and they just get themselves caught in a kind of a tizzy, not getting anything done. And we just walk in and basically just de-risk the transaction by not giving the capital up front and do it anyway. If they've got client concentration, great reason not to give them money up front. If they haven't got stuff properly documented, great reason not to give them money up front. So you rebalance the risk based on what you discover, and so often we often find either myself or the members of my community are often up against search fund competitors who have the money but can't get the deal done, and they're missing the motivations of the seller. The motivations of the seller are not necessarily the money, although of course they say that. They need to get out, they need to move on, they need to go do whatever it is they want to do next. And the search fund is worried about the fact that there's a contingent liability in the balance sheet that they can't figure out how they're going to give them 100 grand without having that potential liability in the future, and they get themselves caught up in knots over the wrong things.
No, that's really helpful. I mean, I think look, the main purpose of why we built our educational platform is to help people learn by doing, help them actually learn the skill by actually analyzing a deal. And, a lot of times when you go to college and look, I mean, I have a PhD, so I've done a lot of school in my career. And I think I think some of the structure is helpful. I think the big value is kind of going on trips and having experiential experiences with other people in college and having that whole college experience. But I'll tell you, I mean, I had the most fun when I got out of college and I was making money. I was working at my first job and I could actually travel and pay for a bar tab and everything. So it's like I was happy to be out of college, and like any other school I did after that, I had my was fortunate to have my my employer subsidize most of my education. And you go to a top business school, you're learning from people that are professors at universities that probably have never started a business or have never invested, and you're seeking to get wisdom from them, or your peers who are also unemployed students that are looking for a job, right? So it's like you got to think about who you're surrounding yourself with, and if you want to learn the skill, sometimes you just got to do it versus kind of learn the theory of it.
Yeah, and I think there's no right or wrong way. Everybody takes their path, and you can't see what the ramifications of doing it a different way would have been. So, you don't know what it would be if you just went and started a business. I don't know what it would be if I'd stuck around until I got a PhD. So, all we can do is, start from where we are and play the cards that we've dealt ourselves and get on with it. And it's interesting. You see highly successful people with university degrees, and you see highly successful people who dropped out. And during the tech boom in the 90s and noughties, we did see a lot of people arrive in the Forbes list who didn't go to Harvard, but hire people from Harvard. I think that was an Elon Musk quote. And then Bill Gates and all those kind of people who famously dropped out. Mark Zuckerberg famously dropped out. All of those kind of people. But they had they were at college, they were at university in order to drop out. So they'd made it to a school to drop out from. So look, I don't think there's any right or wrong way. But
Absolutely.
If you look at the Forbes 400, 220 of the 400 took their companies public and grew their wealth on the public markets. Only about 100 is inherited wealth, and only about 25 are through real estate. So there's a fairly well-trodden path as to how to create wealth.
And I mentioned this on the pod. I got a really good friend that had a massive exit, and he's on, I think, his second or probably third or fourth company. And this company is trying to take it public. So he shopped around a couple different exchanges. I also have a relationship with the London Stock Exchange. They have a presence in New York. So it's really interesting how these different founders kind of shop around and look at different options to go public. And, this founder in particular just wants to, ring the bell on NASDAQ. He's like, Joel, when you come out, when we go public, you're going to go up there with me and ring the bell. So some people just want to, go public in America. But would love to hear your observations with, obviously the 100 companies that you've taken public and helped have acquisitions. What's kind of the pros and cons with the locations? And, are there recommendations that you offer based on the type of business, right? If it's a fintech business, does it make sense to go public in, the Russell 1000 or NASDAQ or if it's a manufacturing business, or there's some pros and cons to, going public in Australia? I do know that there's different price points, right? I know it's definitely more expensive to go public in America than it is in Australia, but would love to have you break this down, the landscape of just going public and pros and cons.
Yeah, so the first company that I took public was actually was a small roll up of marketing agencies, and the largest marketing agencies in the world are publicly listed roll-ups. So we figured we'd do a publicly listed roll-up, and as part of that, we analyzed 50 stock exchanges around the world in terms of their rule book, their liquidity, the criteria for listing, the average performance of companies that list there, quite a bit of detail. Nowadays you could probably do it with AI, but back then it was a massive spreadsheet with all of the kind of analysis that we did on these 50 different exchanges. And a few things really jump out. The first one is, you don't really want to list in the US until you're $1 billion plus market cap. And bear in mind, we did this analysis in 2006, and I think it's more like $2 billion now. So the problem with the US is obviously everything below that threshold, there's not really an institutional investor base. There are a bunch of degenerate gamblers who claim to be investors. But there isn't really that proper institutional base below that level. It's, you're classified as a penny stock, you're classified as a small cap, and most small caps struggle to break out of that territory of being a small cap. I think a lot of shareholder value, trillions of dollars of shareholder value, has probably been destroyed by people listing where they live. So, Chinese companies listing in Hong Kong, London, British companies listing in London, American companies listing in the US, when in fact there probably would have been a better home for them. And I mean, the example I often give is like HSBC Bank, Hong Kong Shanghai Banking Corporation. So if you go to Hong Kong, you go to the Mandarin Oriental Hotel and you open your curtains, you'll see Bank of China and HSBC headquarters like next to each other. And they're broadly similar banks. They have investment banking, business banking, corporate banking, retail banking, mortgages. What they do is not too dissimilar. Bank of China decided to list where they live in Hong Kong, and HSBC listed in London as at the time it was the second largest financial capital in the world, and there's a lot of banks listed in London, as a consequence, you found that HSBC, despite having a terrible reputation, they were famously laundering cartel money and all sorts of things.
Wow, yeah.
They were getting really bad news on a really regular basis. Allegedly, I'll have to use. I don't know if they're actually prosecuted. I think they settled all the cases by just paying out various governments for their transgressions, but they constantly had this negative press, and yet they were trading at a 12 times earnings multiple, while Bank of China, just by choosing to list in a friendly native language country, was trading at 7 times earnings. So hundreds of billions of dollars of destruction of value by listing where they live. And we see this a lot in the US as well, where companies that are way too small spend all that money to list on NASDAQ. It's $1 million to $2 million, depending how you do it, by the time you're finished, to get listed. And then you just get panned, you get shorted, you get, litigated against, you get all these kind of issues. So, one of the things that we realized is that you do have to find the right starting point for being a listed company. That can sometimes be an overseas junior market, even if you're an American company, because you can come back to the US. There's nothing that says because you listed on London or Frankfurt or wherever it was that you have to stay there. You can come back. In fact, you mentioned Australia, London, and Singapore came up, and this really annoyed me because I lived in Singapore at the time. And I'd love to do a roadshow 100 meters from my house, but it wasn't possible. But Australia, Singapore, and London all came up as countries where the cost and compliance outweighed the benefits. So you still had really high cost and really high compliance, but without the liquidity or the market depth or the institutional availability. So in London, Australia, and Singapore, most of the investors are local. Obviously, the UK is a decent sized economy, so you can drive quite a bit of local interest, but it's still hard to get people from other countries to come and invest there when you're a small company. So we quite like European exchanges because the euro is now, 27 countries are in the European Union. The euro is a very well accepted currency pair with the US dollar. It's a little bit easier to attract investors into euro-denominated stocks than it is Australian dollars or Singapore dollars or things that people just intuitively don't know the value of, whereas many people know what the cost of a euro is because they see that pair all the time. So, and also just, things like lockups, flexibility of issuing new stock, doing acquisitions, all the things that we want to do are way simpler and easier under the corporate governance of European companies than they are under the SEC kind of regulations. And the cost is dramatically different. So a relatively simple filing in the US might cost you 100 grand all up. It'll cost like 2 in Europe. So it's a 5% of the cost, 20th of the cost, whatever you want. It's it's a lot less. And we see that all the time. There's just this huge cost differential, which when you're first listing, you don't want all of your free cash to be tied up in the cost of being a listed company. But a bit like you said, if you learn to be a listed company on one of these exchanges, you get used to reporting, you get used to all these things.
What are some of the trends that you've seen across 100 companies that you've worked with, based on industry, based on the founders, maybe just some high-level observations across?
So interestingly, the equity story is important. So that it has to have a story that makes sense. Roll-ups of boring businesses don't, despite the fact they spit off cash and they're great businesses, don't work that well in the public company environment. It is a news-driven environment. People are always buying the future with public companies. So, the past is relatively immaterial. It's all about what it's going to do next week, not what it did last week. And so that's, just a truism. So it has to be a business where there is a good news flow in terms of things that it's about to do or things that are coming up. So whether that's acquisitive news or a really good organic kind of story associated with it. And actually, the stock price is mostly driven by what the chart looks like. If the chart is going up, people buy it, and if the chart is going down, people sell it. And we spend a lot of time and attention on things like fundamentals and dividends, and really nobody cares when you're a small company. So you'd even go to fund managers who specialize in value stocks, and you'd show them a value stock, and they would and they wouldn't buy it because it was going down. But if it was going up and it was at 3 times the price, they would happily buy it, and then they'll use the fundamentals, and they'll use the other stuff as a justification for why they bought it, but they look at that after they've bought it. And it's interesting. I think crypto is a bit of a window onto that world, because crypto is kind of stocks without any fundamentals. So, you know, I mean, they argue tenuous fundamentals, but there aren't really any fundamentals. And so what you see is, you know, Bitcoin at 16,000 and no one's buying it, and Bitcoin at 120,000, and it has the highest volumes in history. So they love it at 120 grand. They hate it at 16. And why do they love it at 120? Because it's going up. So and those market dynamics seem to be very, very true in stocks. So it really doesn't matter, you know, of course, fundamentals are important long term, but actually in the short term, it's more important that there are more buyers than sellers. So
and then in terms of the process, I guess, how do you guys get involved when you take these companies public? Do you pretty much serve as like an investment bank in some instances, kind of like a Goldman Sachs, where you help them go, you know, you help them with all the processes, the steps, kind of the infrastructure to kind of do it in a seamless way?
Yeah, I mean, M&A is in our DNA. So we've been buying and selling companies for 30 years, and that's what we love doing. And so we're always drawn to roll-up stories. And then, of course, there's always the exception that proves the rule, and the business you come across that you really love, that you want to work with. But fundamentally, we either buy businesses and take them public, or we collaborate with the business owner on an equity basis. And part of that will be to take them public and help them roll up their industry. So if you looked at our team in our organization, it looks a bit like an investment bank, but we're not an investment bank. We're more private equity in terms of our kind of approach. And we're kind of broken into 3 separate business areas. So we have Unity Group, which is the boutique investment bank bit, the bit that takes equity and takes companies public and does the M&A and all of that sort of stuff. We have a community called the Harbour Club, which is the largest M&A community in the world, or paid M&A community in the world. And that community drives deal flow like crazy. So we have 3,000-4,000 members, something like that, around the world, who are actively running around doing deals. And so they bring us deals that they think fit our profile, and then we can evaluate and see if they actually do, which means we're always sitting on a lot of deals that we could do when we're ready. So we've got over 100 deals in our pipeline right now, and so our job each month is to pick the 1 or 2 that we're actually going to do. And you know, that's always difficult. It's like picking a favorite child. But yeah, that gives us fantastic deal flow. And then we have our fund, which I know you have funds. So we have a regulated Singapore fund, which is a fixed income fund. And we have, we issue actively managed certificates as well. So like mini funds, which we use for pre-IPO investing, because pre-IPO is always a tricky part of the process, because you need the institution on the cap table, but you want patient capital. You don't want those degenerate gamblers I was talking about. So by having these AMCs, they become professional investors in every deal that we do, and they're gentle when they sell, and they make very good returns for the investors that sit there. So it's kind of an ecosystem.
Yeah, that's helpful. Walk me through, one of the topics we've been talking about is just making it a win-win. So if there's an example of kind of like a win-win transaction where it's just kind of a slam dunk for both the entrepreneur plus obviously the investor, and trying to do it, as you mentioned, without private equity or venture or just debt capital. Would love maybe a case study or one of those situations.
There's hundreds. So I mean, if you look in terms of the deals that we do, so where we're getting involved in a company and taking it public, quite often we're solving a number of problems simultaneously. So, for example, we have a railway business at the moment, and the railway industry, to me, I knew nothing about it a few years ago, but the railway industry attracts budgets like defense. the French government right now is spending 158 billion euros upgrading the French railway system. They're not putting a single mile of new track in, but they're spending 158 billion on upgrades. The only time you hear those kind of numbers is when somebody's buying like a submarine or a battleship or like fighter jets or something. You don't normally get those kind of numbers in kind of everyday life. So the great thing about railways, every country has several, because they normally have underground networks, metro networks, they have mainline networks, they often have freight networks as well, specifically for freight or privately owned freight networks. So they've all got multiple railway networks. They've got these huge budgets that get thrown at them. And there's a few really large incumbents in the industry, big multinational kind of engineering firms that control that market. So a smaller new entrant to that market really struggles to compete against those huge elephants. And a lot of the business is won by tender, and that tendering process is really slow. So for this particular business, there were a number of aspects. One of them was by becoming a public company, they were able to tender for a lot more business directly themselves. So at the moment, well, prior to listing, most of their business came from these large incumbents, effectively subcontracting work to them, whereas quite capably go and pitch for that business themselves if they could build enough trust with the national railway operators, who are generally sovereign decision makers. And so by being a public company, that really helps them do that. The other one, attracting the best talent from their industry. Very hard to get the best talent to come and work for you unless you can give them share options, and share options only really have any value when there's some justifiable value to those share options. So with a public company, you can go on Yahoo Finance and see the value of those shares. So when you give people share options, it means something, rather than giving them in a small private company. And then the other one was just access to different streams of capital. So they could scale their business much quicker if they could lay their hands on, in their case, it was $5 to $10 million worth of additional working capital. The problem they had is that to take that 5 or 10 million as a private company would be very dilutive. And all of the investors, because they got many offers, in fact, many from private equity funds, who would put the money in, but they want so many strings attached to the capital in terms of control and what they can do going forwards. Whereas as a public company, they had more offers of capital, and all of those offers just have ordinary shares. They don't have any additional shareholder rights above. And of course, it's at a much higher valuation. In fact, one of the offers of capital they had as a private company was at around 35 million valuation. They're actually listing at 110. So it's an order of magnitude. So to raise 10 million at 30 versus 100, a whole different kettle of fish. And also at 35 million, that they were tied up in knots. They had to have give away a board seat to the investor. They had all sorts of reserve matters in the shareholders agreement. Basically gave these guys tons of control over what they could do and what they couldn't do and everything else. Whereas a public company is just ordinary shares, so everybody sits alongside each other at the same, on the same basis, and they've got more offers. There are more institutions that can participate in the public company than could in the private one, because they were a bit small for private equity, so they were kind of in a strange space where they're a bit too big for angels, a bit too small for PE. So for that particular one, going public was a really good solution because it ticked a number of boxes for them. And then just in our community, we have hundreds of people doing deals every day with owner managers of businesses. And actually, the biggest thing right now is owners that want to retire. And as I say, a lot of them are messing around with like search fund people, getting bogged down in due diligence, where what they really want to do is go and live in Tahiti or just get on with their retirement. And so actually giving them a path of least resistance to get out of the business is often more valuable than giving them a couple of $1 million in cash on day one. And so recognizing the real motivation of the owner is sometimes the most valuable thing people can do. Instead of thinking it through their lens, which is, I need to get this guy $2 million somehow, it's figuring out what do they actually want? What are they going to do next? And can you get them there quicker and more easily?
Sure. Amazing. Well, Jeremy, I thought those are some really good examples I end every pod with just one piece of advice. So it could be from a family member, it could be from a mentor, it could be from a business partner. Just give us one piece of advice. It could be about life, it could be about business, whatever you want to leave with us.
God, yeah, that's a tricky one. I mean, I've been blessed to have so many great kind of mentors, friends, etc. throughout my lifetime. But I mean, I think one of the things that really sticks in my mind is that a deal's not a deal until it's a deal.
Sure.
Everybody loves to talk about the one that's coming, and that's normally the thing that makes it not happen.
Sure. Yeah. Don't count your chickens before they hatch.
Exactly. Yeah.
Absolutely. Well, hey, Jeremy, thank you so much. And everybody else that's listening in, have a great day. And thanks for tuning in. Appreciate it.
Cool. Fantastic.
Right. Bye. Take care. And how global markets are driving capital allocation. So join us on this journey as we explore these insights.